Hello and welcome to Leviathan News. I'm Samuel McCullough and I'm joined here with my host, DeFi advisor. How you doing, sir?
I'm good. How are you?
I'm great. Yeah, it's a beautiful day. It's becoming spring and warming up. And
Amen.
I know. But we also have some other projects that are heating up pretty hard.
Oh, yes. Nice.
This is somebody that you actually wanted to bring on. And we're really excited about. And we have a double header here today. We have Kohaku from Orange Finance, and then also BossImp from Stryke, which was formerly known as Dopex, here to talk about their new, what is it, LDPi vaults.
LPDFi, I think.
Yeah, LPDFi. Yeah. So welcome, guys.
Hi, I'm Kohaku from Orange Finance, and thank you for having me, having us here today, and I'm really excited to be here.
Thanks
Hey
for
guys,
coming.
how are you?
I'm good.
Yeah, sorry.
Well,
Hey
Boss,
guys, happy to be
this is-
here.
This is your second time back, right? We've
Yes.
yeah.
I had a great time last time. It was a very nice chat. Looking forward to this one.
Well, you guys were Dopex before, and now you're Stryke. So maybe we can start there. What was the reasoning behind the rebrand?
Yeah, so basically we were a double token model, and now we're transitioning to a single token model. And also, since like our V2 CLAMM, we kind of find a nice PMF. The product is very nice. We think it's like fits very well with like the traders, even the LPers, and we wanted to kind of get a fresh start and rebrand into around this CLAMM and build around it, and continue shipping around it, and like kind of do this rebrand fits well at that objective, I would say.
Can you talk about that a little bit, or go ahead?
Yeah, exactly. No, that's exactly what I was saying. That maybe you can explain a bit about the CLAMM for the audience who doesn't know, and then maybe you can also expand on why you guys decided to like switch from the two token model into one.
Yeah, sure. So CLAMM is for concentrated liquidity AMM. So in simple terms, we instead of building, we're building on top of UniV3. So what's the advantage of building options on top of UniV3? UniV3, if you like use it in a certain way, it has the exact same payoff as an option. It means you're naturally, when you have LPers that provide UniV3 LP, they're naturally selling options. It's the same thing as LPing. So what we do is basically we offer traders the possibility to buy the impermanent loss from the V3 LPers to give them more than their fee, than what they get in fees on UniV3. So it's a win-win situation. The LPers win because they get more fees and so more APR. The traders get nice leverage, non-liquidable, and we can do it on any UniV3 pair. We don't necessarily need, we just need them to provide LP in UniV3, and there is a huge TVL in UniV3. We can have on all type of alt tokens, like, I don't know, we have R, but in the future we can have OP, we can have a lot of other, even like newly launched token that don't necessarily have, they need just to have an UniV3, and it can support any DEX, UniV3 or fork of UniV3 or any concentrated liquidity. So that's nice. So I don't know, tomorrow there is a new token that launches. We can, as long as it has UniV3, we can create an options market for it and provide leverage to trader and optimize liquidity return for liquidity provider. So previously we had this double token model with the DPX token and the RTPX.
Before we get to the double token model, let's just talk about Uniswap V3, right? So this is a handy little price there. This is done by Gaim and Gaim Lambert, and this shows that when you provide range within Uniswap V3, this is kind of what it looks like, right? There's like a lower band and an upper band, and let's say this is like ETH USD. If the price goes lower, when you go in outside the lower band, now you're like fully in ETH, right? And if the price goes higher, now you're fully in USDC. So the payoff structure from this kind of looks almost exactly like a covered call or
Exactly.
right. And so essentially providing liquidity on Uniswap V3 and V2 as well too in some respects is essentially just opening up a quasi options opener. And
Yeah.
this is what Dopex has been working with now Stryke over the past. You guys are coming up on 2 years of operation now, right?
Yeah.
Yeah.
So just to you mentioned, I think V2 also. V2 it's a little bit different than V3. It has also some non-linear effect on like you can sell the impermanent loss and it give you nice leverage, etc. But it's not the same payoff as an option, but it's still nice. Like you have that leverage, but it just with Uni V3 whether it's a range or a tick, because how it's structured in UniVC, it's a range. So you have a lower price and an upper price. When you use a full range, you can also sell volatility. It means you're selling a call and a put. But here, what we were doing, we are putting it like one step forward. We're not using a range, we're using a tick. So a tick is just depending on the feet here, it can be like $1, $2, $10 wide tick. And why are we using that tick? It's because we can sell either a call or a put on that tick is easier, and we can, like, when you divide a range into a number of ticks, you can have full utilization of that range easier, and you can provide really like it kind of comes with the capital efficiency, and you can provide people with more strikes, so with more like ways to bet on the volatility. If they expect a big move, they can buy a tick that is far in the range. If they expect like a small volatility and not like, I don't know, if they don't expect like a 10% move, they accept only 4% move, they can buy a tick that is closer to the current price, etc. It offers more versatility for the trader, and also it offers on average more premium for the LPR, because with more ticks on average they will get a little bit more premium because they can sell strikes across the range. When you provide only a range, you can sell only one strike. It's the average of that range.
Yeah, I think here's I'm going to just bring this up. This was in the Orange Finance blog, and this kind of shows like all the ticks within the range, right? So, I mean, this talks about like auto rebalancing stuff, but you can essentially sell out the individual ticks, which is kind of how Uniswap works. Like you depending on the fee structure that you have, there's a defined amount of ticks within it, and you're essentially providing liquidity within. So like you could buy a tick outside of the range, and that essentially represents like either a put or a call, like an out of the money put or call. And ticks within the range are like in the money, and will earn some fees. So yeah, it's a really nice and pretty awesome way to build an options protocol. I know that it's definitely a move up in terms of technology by having Uniswap V3, and it's great to see that you guys at Stryke, aka formerly known as Dopex, have been able to build this system out.
Yeah, I would add, like, it's really nice because when you have the traditional AMM model where people will provide, like, I don't know, ETH or USDC, and you have to edge, it's on the responsibility of the protocol to edge the exposure that the traders take. So the protocol trades against the trader. Here, the protocol acts really like an exchange. The risk, or like the risk is natively edged by design, because the LP is UniV3. So the protocol can work as an exchange, as facilitating LPing, as guiding LPing, etc., and externalize that risk to UniV3 LP. At the same time, you can see like market makers and players, or even like DeFi investors that are looking for yield and looking for optimizing either on in EV3, or the market makers looking to LP. They have a defined risk. They know what they expect because the risk of in EV3 is really defined, is really well known, is very understood. So they can work with LPing, for example, on top of Dopex, and edging that by options, by perps. They can like work around. They know their exposure. When you have an AMM, they don't necessarily know their exposure, and they have to adapt to traders coming, buying, and selling option, etc.
Yeah.
So that's the other advantage on the liquidity side.
Yeah. So let's talk about the switch from the 2-token model to the 1-token model. What's going on there?
Yeah, so we previously had a rebate token, RDPX, and our main token, DPX. And we felt like it kind of, at one point, especially with our transitioning to CLAMM, like we kind of found this market fit where we don't necessarily need any more the rebate token, because like I said, it's just for people who have UniV3, they want to optimize their UniV3, looking also for yield, and on the same time market makers know their risk, so we don't necessarily need any more this rebate token. We previously tried to do kind of a synthetic ETH to use it as a rebate, but sadly like we didn't find like the real fit on that product, and it didn't like go as planned, let's say. So we pivoted to with this CLAMM. At the same time, with the success of CLAMM, it made like the smart move to pivot to a single token to also get more to also be able to provide deeper liquidity for one token rather than having two tokens and having less liquidity. And also it makes sense like to build around this CLAMM with, for example, like Orange Finance coming to do vaults on top of us. Hopefully others also will come. We're more also like with different strategies. We can do a lot of things on top of the technology we built, and we will have also more things coming in the future and more protocols building on top of us.
Yeah, I mean it's great to see this progression from you guys. I know that it's a good roadmap that you guys have been working on. So, you know, what we're here today to talk about though is Orange Finance and how you guys have integrated in with there and created LPDFi. Kohaku, maybe you could talk a little bit about Orange and how you guys are integrated with Stryke.
Yeah, sure. So we're developing Orange Finance, which is basically automated liquidity management protocol on top of those LPDFi protocols in the DeFi space. So we actually kickstarted actually this is the old UI. We need to replace the link. So we started the Orange Finance as a normal automated liquidity management protocols, basically for concentrated liquidity type DEXs such as Uniswap V3. So we have developed the vaults on top of Camelo V3 and Uniswap V3, which is a basic automated liquidity management vault. So basically, we just frequently rebalance the position on top of those Uniswap V3 type DEXs, but we kind of pivoted our focus from normal DEXs to LPDFi space. So as boss LMP can briefly explain that, so LPDFi represents a fresh approach where protocols leverage LP positions on DEXs to craft innovative products such as options and perpetual markets. And we believe this innovation improves capital efficiency and profitability for liquidity providers. But on the other hand, like this may require more complex and active liquidity management for liquidity providers, because the liquidity is basically, especially for the Strike case, retail users need to like manage liquidity in tick level. So the liquidity is kind of fragmented, and to like for rebalancing, they actively check the every ticks in the Dopex Clam pool, and frequently check the utilization rate of those liquidity, because those liquidity can be, borrowed by option buyers on the counterpart. So this is quite tricky and it's I would say really complicated liquidity management. So what we are doing, Orange Finance, is developing the automated liquidity management vault on top of Strike. So we actively rebalance the position by monitoring the utilization status and market condition, and we implement those strategy automatically on behalf of retail users. And
so from what I understand of what you guys have put out so far, like this picture is kind of represents like what happens in Stryke Dopex when option traders are essentially taking those ticks, right? They utilize those ticks. There's a certain amount of that utilization which is used inside each tick, and so it can lead to times when you don't really have a balanced pool, if you want to call it. And so from what I understand of Orange, you guys are coming in and managing that liquidity so that the essentially all the tick levels kind of balance out eventually.
Yeah, exactly. And like especially for this moment, like Stryke now distributing STIP option rewards for the range within the 2.5% from the spot price. So there is a huge demand for in the Dopex community, I mean Stryke community, to rebalance the position to follow the qualified range for STIP rewards. So what we are doing right now with our vote is, our current strategy is we frequently rebalance, monitoring the market condition and utilization rate, and try to maximize the STIP rewards by putting the liquidity within the 2.5%, which is actually 2.0% price range at this moment, to be qualified anytime for STIP rewards.
Yeah. So we have a nice little thing here that shows like as the liquidity goes outside of that 2.5% range, it's then burned and moved into a different range and then rebalanced across the entire pool. And so that allows for greater depth of this options market, both for traders and then for LPs as well too. And it most likely should increase the trading fees that you guys are collecting, because it's acting almost as like a like an on-chain DeFi market maker.
Yeah, exactly. And so we have been developing those votes like since last year. I mean, from the normal AMMs like Uniswap V3, and we have seen the improvement of capital efficiency and the return actually, because like liquidity within the range are earning the trading fees from Uniswap V3. I mean, which is underlying pool for Stryke, and even the out of range liquidity is earning option premiums from Stryke. So that's actually quite improving the capital efficiency and profitability for liquidity providers.
Yeah, it's always a bit complex when talking about options. I think it's a really difficult subject, and especially when you're trying to use DeFi as a like quasi substitute for pure options markets, right? There's some issues that you run into, like this utilization and also the rebalancing, which have to be dealt with. And I think, Boss, that this has come about as you guys have run Dopex and seen traders utilize the different strategies and also the different pools, and understand that liquidity is something that has to be essentially actively managed in this way.
Yeah, definitely. Like right now, we are a bit skewed with STIP, so we wanted to get like kind of deep liquidity around the money. So we incentivizing like in a 2.5 range around the current price. So that like to get that that leverage for traders, etc. But in theory, if there were no incentives or lower incentives, it can be interesting to get into. You adapt to current market, so depending on your expected volatility, etc., you try to have a 3-4% range around the money to rebalance less, because every time you rebalance, in theory, you have a bit of impermanent loss. But at the same time, if you have money really near the money, you are making almost 1% or even more now, because the volatility is higher, even more than 1%. If it's really close to the money, maybe even 1.5% daily. So that's around 550 APR, something like that. So you need to find like kind of the middle. If the price is going to move a lot and you need to rebalance a lot, it's maybe better to take that wider range, but at the same time you don't want it too wide because it will hurt your overall return. So it's kind of a balance to find, and you can also integrate some volatility edging elsewhere. And if you want to deposit in this 24 hours like vault, and not in weeklies or whatever, you can also have some edging long-term with long-term options around your vault to potentially edge about that volatility and to edge a bit of your impermanent loss. There is a lot of things like you can do as a market maker or as a vault on top to optimize, but it will always like depend on your expectation of the volatility and how you can maximize it. What's your strategy? Do you go for the like static lower return with less rebalancing, or you want to go for that high risk return, but you may incur impermanent loss a lot while rebalancing? But if you don't rebalance that often, or if like the market is kind of consolidates for a few days and you're right consolidating, your return can be 2 times higher or 2.5 times higher or even 3 times higher. That's the game. So you need if you have like a good estimation of what's coming, the volatility, etc., you can build nice stuff and you can like take risks in a way and try to figure out what is the best strategy given the market.
Yeah. Let me just break that down a little bit. So like as your position moves in and out of the range, right? You either have the choice to like wait for it to come back in range, which you definitely can, or you could move the whole position, right? You could just come back into range and maintain that fixed range that you're in, and that's what this 2.5% vault does. It essentially says we're going to create a 2.5% range around ETH/USDC, and then as ETH/USDC is moving around, we're going to adjust that range and kind of rebalance these pools so that they have full like max liquidity as it transitions through.
Yeah,
Yes,
that's I think that's the case, and you don't want to rebalance too often, but you don't want to not rebalance at all, so you don't you lose a bit on the premium and etc.
Yeah, so when it comes to Uniswap V3, I mean, the real like secret sauce is how wide you make your essentially your range, right? Because a tighter range is always going to lead to higher fees because your liquidity is concentrated higher. But if the price is wiggling around a lot, you'll have to rebalance more, and so you might actually lose at the end of the day if you're having to rebalance. So you kind of have to look at the markets and kind of understand what the current volatility is, and then say like, okay, well, I'm gonna provide in like a 1% range, or in your case, like a 2.5% range. How did you guys come to that 2.5% number? And like, would you ever adjust it based on market volatility?
So this is like a kind of temporary for the Orange Finance vault. This is kind of temporary strategy, especially so specialized for STIP rewards, which is distributed on Strike at the moment. And of course, we after the STIP rewards period, we are considering to expand our strategy with the diversification, and we need to aware that we need to consider the volatility of the market, and we need to consider the balance between the fees and kind of impermanent loss coming from the tighter price range. So we are going to analyze the situation in the upcoming market and watching like implied volatility and realized volatility in the situation, and we'd like to like expand our strategy side as well. So 2.5% strategy is quite tailored for the STIP rewards at the moment.
Yeah. So maybe we can talk about the fees, right? I'm looking at the APR right now. It says 3,200%, which is quite a lot.
Yeah, this is big. Yeah, actually, this is like it's come from like our really tight price range with the quite volatile market at the current situation, and so so it's quite fluctuate day by day. So I think we need to reconsider how to display the fee APL and those total APL.
What's the rate of the change? Or like, what are the ranges that it was like in the recent days or so?
The recent current, let me check.
I think it was around the 250, 300. This may be a bit inflated because there was a migration recently, so this is new vault. If correct me if I'm wrong, Kohaku, but I think this is like a recent vault. So it may be like the fee is a bit inflated because it just launched, so it just like inflated by, I think, in the recent, like the past week on the previous vault, it was around 250 APR, 300 if I'm not mistaken.
Great numbers.
Exactly.
Great number.
The APL is around that.
Yeah. So like once the STIP ends, is it still going to have this this like fee reward? Is this just based on like the trading fees that are coming through right now?
So
or is it like the volume across the board is quite high right now because markets have just been moving a lot. And like, is this priced in? It's all priced in dollar terms, right?
Yeah, it's priced in dollar terms. Yeah.
Okay. Yeah. So like as the market's moving up and continues to move up, like your cash balance is going to get higher and higher and higher. Plus you get all those fees from the trading as well too.
Yeah. So like actually, so if we consider it in the East term, actually your deposited position is decreasing in the East term, but because it's up and up market, so in the dollar base, everyone is earning in this vault at the moment.
Yeah, I mean, I think that's what people get wrong when providing liquidity for both Uniswap V3 and V2 is that it's like permanent. I always thought that impermanent loss was kind of a myth. It's not something really to take into account. Like I worked as an options trader for a while, and you know, we're never like counting our unit basis in the amount of stock that we have at the end of the day. It's all cash balance, right? You're just focused on what the cash balance is. And so like if markets are moving up and you're long, you know, your option trading or selling or buying is really at the end of the day just coming back to your ending cash balance at the end of the day. And so like if the market started to move the other way and they started to decline a lot, could you have like you would have like a negative APR, right?
Yeah, it can have a negative APR. So actually, previous to this LPDFi vote, we implemented the delta neutral vote for like Uniswap V3 and Camelot V3. And so we actually we may start developing those delta neutral vote in the future roadmap again. But looking at the current market situation, we are not implementing the hedging strategy for the LPDFi vote at the moment. But we are open to like expand our strategy side. I mean, strategy layer as well.
Yeah. So like, what else will you guys be looking at with Orange other than this like ETH USDC vaults?
So the vote. So besides this West USDC vote, we are also planning and actually developing the votes on top of other pools on Stryke. So such as ARB USDC and WBTC USDC. So we are going to deploy those the LPDFi votes on top of those CLAMM pools, and adding to that, like we have partnered with Stryke, but we have also partnered with other LPDFi protocols and expanding our vote on top of those LPDFi protocols. And at the end of the day, like probably next quarters, we plan to deploy the aggregating votes across those LPDFi protocols.
Yeah. So running a back test in a market which is not moving up 3 to 4% daily, how does the strategy perform? Like just in a kind of crab rangy market?
So in the range market, it was like in total APR is around 130%.
It's pretty good. I mean, you think about like the what you would typically get from an ETH USDC pool, which would be about 30 to 40% from the fees. This rebalancing that you're doing through Orange, and then also the additional fees coming from the Stryke, aka Dopex vaults, would increase that quite a bit and make this more attractive for LPs.
Yeah, exactly.
Yeah. But that's pretty cool. I'm really excited to see what you guys have here. I think like this is like more options style setups, especially when it comes to automated liquidity provision, are definitely needed. I know that there are some groups out there that have taken this on, but the ability to come in and for options traders to also use those individual ticks to then like buy and sell options on is also a cool idea as well too. It's like extra utilization of the Uniswap LP itself.
Yeah, correct. And you can have optimization not only sometimes, like you said, right now the volume is high, so but when the volume was lower, you could get more premium than fees just by selling, so per tick, and also you have more tick that are used, because if you don't move like 3 or 4%, if you LP on a 4% range, for example, usually in daily we don't move the whole 8% width, so minus 4%, superior 4%, so you'll be selling all or like the majority of ticks of your range, but the price won't hit the majority of ticks of your range, so you're getting more premium than you would have active from the ticks than fees, and you'll get sometimes even more per tick premium than fee. So it's a double optimization. Right now we have more volume, so sometimes like you can get more fee than premium per tick, but you have more tick that are active for premium than they are active for fees. Hopefully that was understandable.
Yeah, no, I understand that. It's just all about coming up with extra ways to have that collateral that's in the LP be utilized. I mean, that's really the issue at the end of the day when people talk about like LVR or some of these other issues, like loss versus rebalancing or other issues that have to do with like Uniswap, right? I know there's ongoing discussions about how do we make Uniswap more profitable? How can we make these trades for essentially market makers match the returns that they could get inside of like a centralized exchange? Really hard question to solve. But I think that
I have a few ideas if you want.
yeah. Well, I mean, let's hear him. Is loss versus rebound? Okay, before we talk about LVR is essentially this. So if you're a market maker or an LP or whatever you want to call it, there is a like natural carry cost for the assets that you have. It doesn't mean if you have them borrowed, even if you hold them, right? Like there's a kind of a base rate that you should be earning, which you can like quantify through the options market or through the perps market or whatever. And so typically people have looked at Uniswap and said like, it's always getting stale orders. Like the quotes that you're getting from Uniswap when you buy are always stale. Because they can be updated faster on the centralized exchanges, and so the lack of speed just means that Uniswap providers always are providing a worse price, and so they create what's called like toxic order flow, and it leads to what they think is like less fees that are earned versus providing liquidity on exchange. So if you're a market maker looking at the market and saying like, okay, where should I deploy collateral? Should it be into a Uniswap L3 LP or Uniswap V2? Versus providing liquidity on a centralized exchange. Typically, the numbers will say that like a centralized exchange is better. And so a lot of groups like yourself over at Stryke and Dopex, as well as other people have been looking at this Uniswap 3 issue and say like, how can we create more utilization so that the fees collected into that LP are higher at the end of the day?
Yeah, but I think like one axis is like you have to think about how you attract more volume on chain. If you attract more volume on chain, you'll have less of the stale issue. And I think one of the some kind counterintuitive a bit would be to lower the fees even more and to get even lower fees than centralized exchange, so we get more volume, and on average that increased volume and the less stale effect may make up for like the difference in a way. So I think if we are able to find somehow a way to attract more volume we can on chain, whether it's with lower fees or whatever. It's similar to like even not on Uniswap, but in options in general. Right now we are competing DeFi vs CeFi, and fees and CeFi are almost criminal. So one major axis would be to lower really fees on DeFi and to bring a lot of volume and a lot of market makers on DeFi. And to yeah, because I say criminal because they're 3 bips, so 0.03% on Deribit. I used to trade options like, I don't know, in US markets, I would pay $1 for 400, sometimes even 1,000 in premium. And right now, sometimes I will pay for $20. I will pay 80 cents trading fees. So that can be like a factor of 50, or like of sometimes of 10, of 50. And literally some strategies I would like to run on ETH and BTC are not profitable because with the fees, I need to be making at least 60% to break even.
Oh, wow. Yeah, that is crazy, because you could buy like I know some of the providers out there, like the low cost option providers, like what is it? It's like $1 per option.
Yeah.
Right. Which is great.
Around that.
Yeah. So if you're wanting to do, I mean, like if you're wanting to run like an Iron Condor on Deribit, that must be really expensive if they're charging.
Yeah, that's now I think it's around 90 cents. No, even more. Maybe it's 0.03%. So it may be 80 cent, 80, 90 cent, I think, minimum.
Oh, wow.
And if you do four legs, it's going to be $4. Unless you do like this block trade with like 500 options, I think, and sometimes the liquidity is not even great on that. So yeah, it's really expensive. So if I do a round trip, it's $8. So sometimes my butterfly or like my Iron Condor is like $10, $12. So I pay $8 in fees for $12 in premium.
That's a lot.
Yeah.
That's a lot, but maybe there'll be a Deribit token and we can enjoy those fees.
Yeah, just to add something on this point, I think once we have option on ETF, like on BTC ETF and hopefully on ETH ETF, I think the game will change and people will be forced to match the fee on US options, or they won't survive, basically. Personally, I'm looking forward to options on ETH on ETF because I will have the liquidity, more liquidity, I think, and I'll have lower fees. So I'll be able to do tons of strategy and trade the shit out of like of butterflies, because I love butterflies, but I've not be able to trade them on crypto at all.
So I'm also excited. I know the SEC is looking at an options for BTC right now. Hopefully they come before the end of the year. I mean, they should, right? There's a spot ETF and they also have a futures market. So getting the options market added to Bitcoin, where the notionals are much higher as well too, as well. So, like you can get pretty cheap options on the Bitcoin ETFs or whatever you're trading, and the notionals can be quite large there, which is good at the end of the day. Lowers your fees.
Yeah, definitely.
Yeah. Well, cool. Really excited to see this. I might have to go put some funds into the Orange Finance if it's printing 10% daily. That's pretty incredible right now. So Orange Finance is orangefinance.io, and you guys are still at Dopex, but when are you making the transition over to Stryke?
Yeah, I think in the coming weeks. I don't want to give a hard date, but it should be like in the, let's say, in the coming weeks, 3, 4, 5, 6 weeks, around that.
Amazing, guys. Well, we'll have the links to everything down in the show notes, and also you can find all the information on Orange Finance's site. We'll have that in the show notes as well too. Make sure to follow us on Telegram. We have a great news channel that comes out, and it is pushing out news on a daily basis. We have all the headlines in there, some great memes as well too. Might be some Leviathan points at some point. And yeah, thank you for tuning in today, DeFi Advisor. Thank you for bringing these guys on. It was a great discussion.
Thank you. Thanks for coming, guys.
Yeah. And BossImp and Kohaku will have to have you guys back on soon.
Yeah, thank you very much
Yes.
for today, and
It's
yeah, I'm looking forward to it.
it's always a pleasure to come here. Like I like the conversation, like the flow. So hopefully, looking forward really to next time. Thank you for having us, guys.
Sam is the best, to be honest.
Always, I like talking about options. It's my it's always fun to do that. So you guys are welcome to come back anytime. And thank you for tuning into Leviathan News.